Equity financing refers to the raising of funds by offering investors part or full ownership of the business in exchange for the funding. Unlisted companies raise equity funding by offering shares to identified investors. These shares are, however, not listed at a securities exchange and do not have an active secondary market. Unlisted companies include private companies, public companies limited by shares, unlimited public companies, and unlisted no-liability companies. Public listed companies, on the other hand, raise capital through issuing of shares in a registered stock exchange. In Australia, this is done through the Australian Securities Exchange, or the ASX. There are a number of rules set out by the stock exchange that must be adhered to in order to make a public offering of shares. In Australia, these rules are set out in the ASX listing rules. When issuing shares, a company can do this either as a primary issue, which is referred to as an initial public offering, or an issue of shares to existing shareholders. An IPO is only applicable to companies not previously listed on the ASX. The company would offer the shares at a specified value normally arrived at after considering various valuation techniques. These valuation techniques include the net present value of forecast earnings, the price earnings multiples on future profits, and cash flow multiples relating to future cash earnings. A rights issue is the term used when issuing shares to existing shareholders in exchange for consideration. That is, it gives the shareholders a right to purchase additional shares, and this is based on the existing shares held by the shareholder. As an example, each shareholder may receive a right to purchase one additional share for every 2 shares already held. The theoretical value of these rights becomes important in these types of issues. Note that this is not the value of the shares being issued, but rather the value of the right to purchase the additional shares. This is determined using a formula which considers the number of shares that must already be held by the shareholder in order to exercise the right to buy an additional share. The price to be paid by the shareholder for the additional share, also referred to as a subscription price, and the current market price of an existing share held by the shareholder. We then apply the formula to calculate the theoretical value of the right. Let's look at an example. Happy Pots Limited, which manufactures and sells garden pots, has decided to raise equity funding through a rights issue to existing shareholders. The funds will be utilized to increase its manufacturing capabilities. The issue is on a 1 share for every 2 shares held basis. The price for each new share is $1.50, and the current market price of existing shares is $2. Applying the formula, we subtract the $1.50 subscription price from the $2 market value and multiply this by 2. This is the number of shares to be held to purchase each additional share. We then divide this by 2 plus 1, which gives us the theoretical value of the right to purchase an additional share of 33 cents per share. Another method of raising equity finance is obtaining venture capital. In this case, the provider of funds is known as a venture capitalist and will provide capital funding in exchange for a percentage of ownership of the company or a share of the profits. This is particularly relevant for startup businesses and entrepreneurs. The venture capitalist will usually exit the company once it is successful. The venture capitalist will do this by selling its ownership share for hopefully a significant profit. To recap, equity funding is obtained in exchange for an ownership stake in a company. A company can either issue shares privately or through a stock exchange. Companies that have not previously been listed can raise funds through the stock exchange through an IPO. Listed companies, on the other hand, generally do this by offering a rights issue to existing shareholders. Startups with high growth potentials can also approach venture capitalists for equity funding. These investors will normally exit the company once the company is successful by selling their shares for a significant profit.